This video is a midterm exam review for chapters 1, 2, 4, 11, and 12 for Finance 304. We'll begin with a quick overview and discussion of chapter 1. The basis for this class is to understand how financial markets and institutions operate, and to understand that they are the primary channels through which capital is allocated in our society. And I believe most everyone probably already understands the difference between primary and secondary markets, but it's important to understand the difference. So primary markets are where new issues of financial instruments are offered for sale, and an example of this is an IPO. This is where users of funds, such as corporations, issue debt. They work with an investment bank to create that product, and they supply it to the initial supply, or they supply the debt to the suppliers of funds. So the suppliers of funds, or the investors, invest in the IPO and all of this happens through an investment bank. And without financial markets, and before financial markets existed, individuals had to seek each other out on their own, and a person with excess funds had to find someone that was in need of funds, or maybe it wasn't even funds, maybe it was goods, and they had to make inefficient deals with each other. But now that we have sophisticated markets, this is how it works in the primary markets. Now, the difference between primary and secondary markets is that in a secondary market, the financial instrument was already issued to investors. Now it's going to be traded in the markets. It's not coming directly from the corporation in an IPO. In secondary markets, it's being traded from one owner to another owner. So you have one economic agent that wants to sell their securities. They go through the financial markets and are connected with agents that want to buy the securities. Or vice versa. You have an agent wanting to buy and they're connected with agents wanting to sell through the financial markets instead of having to locate each other and make a deal individually. So financial institutions perform the essential function of channeling funds from those with surplus funds to those with shortages of funds. And in a world without financial institutions, the level of funds flowing between suppliers and users would likely be quite low because of monitoring costs, liquidity costs, and price risk. There are many types of financial institutions. The main financial institutions that exist include commercial banks, and these are depository institutions whose major assets are loans and major liabilities are deposits. You have thrifts. A thrift is a depository institution in the form of a savings association. So credit unions are thrifts, and savings banks, which you don't see many of anymore, are thrifts. Then there are insurance companies. So insurance companies are financial institutions that protect individuals and corporations from risk. Then you have securities firms and investment banks, and these are financial institutions that help firms issue securities. You have finance companies that are a financial intermediary that makes loans to both individuals and businesses, but they're different than a depository institution or a commercial bank because they don't accept deposits. Instead, they rely on short and long-term debt for their funding. You have investment funds, so financial institutions that pool resources, financial resources that belong to individuals and companies, and they invest those resources in diversified portfolio of assets. You have pension funds, where financial institutions offer savings plans through which fund participants accumulate savings during their working years so they can withdraw them during their retirement years. And then you have fintechs, or financial technology firms. These are institutions that use technology to deliver financial solutions in a manner that competes with our traditional financial methods. Financial institutions face various types of risk. They face default risk, meaning they've issued a loan or a credit to someone, and the person that is supposed to repay the money defaults on their agreement to repay the money, so the money doesn't get paid back to the financial institution. They deal with foreign exchange risk. They deal with interest rate risk, market risk, which is also the price of assets in the market risk, off-balance sheet risk, liquidity risk, technology and operational risk, and insolvency risk. Financial markets are structures through which funds flow, and they can be distinguished along two major dimensions. As we discussed earlier, we have the primary markets versus secondary markets. We also have money markets versus capital markets. We've already discussed the primary markets and the secondary markets. And now to discuss how funds would flow in a world without financial institutions versus how funds would flow in a world with financial institutions. So, without financial institutions, you have a direct transfer of funds from suppliers of funds to users of funds, and claims would flow directly from users of funds to those suppliers of funds. With financial institutions, we have indirect transfers. So a transfer of funds between suppliers and users of funds. You have your users of funds and your suppliers of funds, but these transfers are administered through a financial institution that works as an asset transformer. Financial institutions act as asset transformers. Financial claims issued by a financial institution that are more attractive to investors than are the claims that are directly issued by corporations. Often, claims issued by financial institutions have liquidity attributes that are superior to those of primary securities. And financial institutions diverse away some, but not all, of their investment risk. U.S. markets are the world's largest, but international markets have seen rapid growth in recent years. And the reason is that there are several reasons, but the first is a pool of savings in foreign countries has increased. International investors have turned to the U.S. and other markets to expand their investment opportunities. Information on foreign investments and markets is now more accessible and thorough. And some U.S. financial institutions offer their customers opportunities to invest in foreign securities and emerging markets at relatively low transaction costs. Additionally, the euro is having a notable impact on the global financial system. Economic growth in Pacific Basin countries, China, and other emerging countries has resulted in significant growth in their stock markets, and deregulation in many foreign countries has allowed international investors greater access and allowed the deregulating countries to expand their investor base. Now we will move on to Chapter 2 and discuss a few of the concepts in this chapter in preparation for the midterm exam. Let's first review interest rate fundamentals. Nominal interest rates are the rates actually observed in financial markets. They directly affect the value or price of most securities traded in the money and capital markets. Changes in interest rates influence the performance and decision-making for individual investors, businesses, and governmental units. The textbook discusses several theories. In these notes and this discussion, I want to focus on the loanable funds theory. The loanable funds theory says changes in interest rates impact security values. Financial institutions spend much time and effort trying to identify factors that determine the level of interest rates at any moment in time, as well as what causes interest rate movements over time. The loanable funds theory views equilibrium interest rates in financial markets as a result of the supply of and demand for loanable funds. It categorizes financial market participants, consumers, businesses, governments, and foreign participants, as net suppliers or net demanders of funds. This table is a great resource for you to use in studying. There are a couple of questions on the exam about these relationships, but this table is an overview of the factors that affect the supply of and demand for loanable funds for financial security. So, I would recommend reading back over the textbook, talking about the different factors. So, the interest rate, total wealth, risk of financial security, near-term spending needs, monetary expansion, and economic conditions, and study the impact on the supply of funds. So interest rate moves along with the supply curve. Total wealth, risk of financial security, near-term spending needs, monetary expansion, and economic conditions. Those factors shift the supply curve. Total wealth has an inverse impact. Risk of financial security and near-term spending have direct impacts, and monetary expansion and economic conditions have inverse impacts on the supply of funds. As for the demand of funds, interest rate moves along the demand curve and has a direct impact on the equilibrium interest rate. Economic conditions shift the demand curve and have a direct impact. This chapter provides a review of the time value of money. The time value of money is the basic notion that a dollar received today is worth more than a dollar received at some future date. Two forms of the time value of money calculations are commonly used in finance for security valuation purposes. The first is the value of a lump sum. A lump sum payment is a single cash payment received at the beginning or end of some investment horizon. The value of an annuity payments. So an annuity payment is a series of equal cash flows received at fixed intervals over the entire investment horizon. So an annuity, an example of an annuity would be a loan payment where you're making a fixed amount paid regularly, for example, once a month over 5 years. And that would be an annuity. A lump sum payment would be a single cash payment either at the beginning or the end of a time period. The formulas provided in the text include the present value of a lump sum, and this is the formula that you use to calculate the present value of a lump sum. If you need to know the future value of a lump sum, you know the amount of the dollar amount today, but you know the interest rate and the amount of time that you're going to invest it. You want to know what the value will be at the end of the time period. You calculate the future value by multiplying the present value times 1 plus rate to the power of time period. So I would recommend practicing with some of these. If you go into McGraw-Hill Connect, it should give you the opportunity to have some practice problems. But you'll have simple problems that are similar to your homework where you calculate the present and future value of using time value of money. Similarly, the present value of an annuity. This is the formula for the present value of annuity that you would use, the equation. And for the future value of a stream of payments, you would use this formula to calculate the future value of an annuity. Moving on for a few discussion points in Chapter 4. Chapter 4 starts to discuss the Federal Reserve, monetary policy, and interest rates. First, it discusses the major duties and responsibilities of the Federal Reserve. Central banks determine, implement, and control the monetary policies in their home countries. The Federal Reserve, or the Fed as it's often referred to, is the central bank of the United States. It was founded by Congress under the Federal Reserve Act of 1913. It is an independent central bank, meaning it is not controlled by Congress or any political motivation. Duties incorporate 4 major functions. The first major function is conducting monetary policy. They also supervise and regulate depository institutions. They maintain the stability of the financial system, and they're charged with providing payment and other financial services to the U.S. government, the public, financial institutions, and foreign official institutions. It's important to know and understand what the Federal Open Market Committee, the FOMC, as it's referred to, is the major monetary policy making body of the Federal Reserve System. This committee is required to meet at least 4 times each year in D.C., but they typically meet more often than that. Their main responsibilities are to formulate policies to promote full employment, economic growth, price stability, and a sustainable pattern of international trade. They set guidelines regarding open market operations, the purchase and sale of U.S. government and federal agency securities as the main policy tool to achieve monetary targets. And there's a document called the Beige Book that summarizes information on current economic conditions by each Federal Reserve district. The Federal Reserve has a toolbox of monetary policy tools that it can use, and it uses the following different tools to implement monetary policy. The first is open market operations. The second is the discount rate. And the third tool is reserve requirements. A major link by which monetary policy impacts the macroeconomy occurs through the Federal Reserve influencing the market for bank reserves. Federal Reserve's monetary policy seeks to influence either the demand for or the supply of excess reserves at depository institutions, and in turn, the money supply and the level of interest rates. So expanding a bit on open market operations, they are the buying and selling of government securities by a central bank to control the money supply and influence interest rates. By purchasing securities, the central bank injects money into the banking system, which tends to lower interest rates and stimulate the economy. Conversely, selling securities removes money from the system, raising interest rates and slowing the economy. The discount rate is one of the other monetary policy tools. And as we mentioned before, the discount rate is the rate of interest Federal Reserve banks charge on loans to financial institutions in their district. So raising this discount rate signals a desire to see a tightening of monetary policy conditions and higher interest rates in general. So raising the discount rate is tightening, and we're expecting higher interest rates. Lowering the discount rate signals a desire to see more expansionary monetary conditions and lower interest rates in general. The Federal Reserve has rarely used the discount rate as a monetary policy tool, and the reasons are it's difficult for the Fed to predict changes in bank discount window borrowing when the discount rate changes, because the banks may find other venues. Additionally, because of its signaling importance, a discount rate change often has great effects on the financial markets, so it can be unpredictable. The additional tool, reserve requirements, determine the minimum amount of reserve assets that depository institutions must maintain by law to back transaction deposit accounts held as liabilities on their balance sheets. So, the requirement is usually set as a ratio of transaction accounts it's very rarely used by the Federal Reserve as a monetary policy tool. An increase, or actually a decrease, in the reserve requirement ratio means that depository institutions may hold fewer reserves against their transaction accounts, allowing them to lend out a greater percentage of their deposits and increasing credit availability in the economy. Depository institutions trade excess reserves held at their local Federal Reserve banks among themselves. The rate of interest, or the price on these interbank transactions, is a benchmark interest rate. It's called the Fed funds rate. Financial Services Regulatory Relief Act of 2006 authorized the Federal Reserve to pay interest on reserve balances. So before that, the Federal Reserve didn't pay interest on reserve balances held at the Fed. But now they pay both interest on excess reserves as well as interest on required reserves. So the Federal Reserve can take one of two basic approaches to affect the market for banks' excess reserves. They can either target the quantity of reserves in the market, or they can target the interest rate on those reserves, which is the Fed funds rate. So this diagram outlines monetary policy tools, the three tools: open market operations, discount rate, and reserve requirement ratio. It talks about targeting the money supply, bank reserves, interest rates, the Fed funds rate are the three ways that it can impact the money supply. And then the financial markets that are affected by that, the change in reserves, the change in money supply, the change in credit availability, the change in interest rates, the change in borrowing, the change in security prices, and the change in foreign rates. All of these things are analyzed after a change. And the objectives that the Fed is trying to achieve includes price stability, economic growth, low inflation, full employment, and a sustainable pattern of economic trade. So they will, if they make changes, if they utilize the monetary policy tools to try and make changes, they will then assess the changes in the financial markets to see, and then measure to see if they have achieved their objectives. If these objectives are not met, then they will look at the tools in their toolbox and decide what actions to take. So for expansionary activities, the Fed would perform open market purchases of securities, and all else constant, reserve accounts of banks will increase. As another expansionary activity, this would mean a discount rate decrease. Holding all else constant, interest rates in the economy should decrease. And third, for an expansionary activity, the reserve requirement ratio would decrease, meaning banks are required to hold less reserves, meaning more cash is out in the markets. All else constant, bank reserves should increase. Contractionary activities include open market sales of securities. All else constant, reserve accounts of banks should decrease. The next activity for a contractionary activity would be a discount rate increase. All else constant, when increasing the discount rate, is interest rates in the open market should increase. And finally, another contractionary activity would be a reserve requirement ratio increase. Holding all else constant, bank reserves should decrease. The impact of monetary policy on various economic variables. In expansionary activities, open market purchases of securities, discount rate decreases, and reserve requirement ratio decreases. The impact on reserves is that they should increase, the money supply should increase, credit availability should increase, interest rates decrease, and security prices increase. For contractionary activities, open market sales of securities, discount rate increases, and reserve requirement ratio increases. The impact on reserves is that they should decrease, the money supply decrease, credit availability would decrease, interest rates would increase, and security prices would decrease. The Federal Reserve can successfully target only one of these two variables at a time, either the money supply or interest rates. If the money supply is the target variable used to implement monetary policy, they have to allow interest rates to fluctuate relatively freely. If an interest rate is the target, bank reserves and the money supply must be allowed to fluctuate freely. So in the past, the Fed funds rate was targeted using reserves to achieve the target in 1970 through 1979. Non-borrowed reserves were targeted from 79 to 82. Borrowed reserves were targeted from 1982 to 1993. And then starting in 1993, the Fed started targeting the Fed funds rate, and they would announce the Fed funds rate. And they still do this today. When you hear the headlines about the Federal Open Market Committee raising or lowering interest rates, they're talking about the movement in the Fed funds rate. The Fed announced that it would use interest rates, the Fed funds rate, as the main target variable to conduct monetary policy in 1993. The guiding principle used by the Fed to set short-term interest rates is the Taylor Rule, which states short-term interest rates should be determined by three conditions. One, where actual inflation is relative to the Fed's targeted level of inflation. Two, the extent to which the economy is above or below its full employment level. And three, what short-term interest rates should be to achieve full employment. Under the current regime, the Fed simply announces whether the federal funds rate target has been increased, decreased, or left unchanged after every monthly Federal Open Market Committee meeting. Now, moving on to Chapter 11, an industry overview of commercial banks. Commercial banks are the largest group of financial institutions in terms of the dollar value of assets. They're also called depository institutions because a significant proportion of their funds comes from customer deposits. Major assets are loans, and major liabilities of commercial banks are deposits. They perform services essential to U.S. financial markets. They play a key role in the transmission of monetary policy. They provide payment services, and they offer maturity intermediation services. Banks are regulated to protect against a disruption in the provision of these services and the cost this would impose on the economy and society at large if they made bad decisions. Chapter 11 discusses the difference in balance sheets of commercial banks and the balance sheets of non-financial firms. And here you'll see that commercial banks' assets are loans. And the assets of non-financial firms are their deposits in the bank account and other financial assets. However, for a commercial bank, deposits held in their bank are liabilities. So the deposits that a corporation, a non-financial corporation, holds in a bank is a deposit on its balance sheet. Is an asset on its own balance sheet, but a liability on the bank's balance sheet. Because that money doesn't belong to the bank. It belongs to the non-financial firm or the manufacturing firm. Commercial banks have investments or financial assets those are on the asset side of their balance sheet, the same as they are for non-financial firms. Additionally, other non-financial assets are also considered assets for banks. The big difference here is loans are an asset for banks. When a non-financial firm goes to a bank and takes out a loan, it is a liability on its own balance sheet, but interestingly, it is an asset on the commercial bank balance sheet, because this is how banks make money. They sell loans. Describing what a bank does in the most basic terms possible, a commercial bank buys money and sells money. Okay? They buy money by taking in deposits, and they pay people an interest rate to keep their deposit at the bank, and they buy that money, and then they sell the money through loans to customers, and they charge an interest rate on those loans, and that's their form of selling money. That's how banks operate. So loans are on the asset side of a commercial bank balance sheet, whereas we're used to them being on the liability side of a non-financial firm balance sheet. And the same for deposits. Deposits to a bank are a liability, but to a non-financial firm who owns their own deposits, they're an asset. The majority of assets held by commercial banks are loans. In 2021, net loans and leases were about 46.7% of total assets. Now, other types of assets, which are like the bank's building and premises and their fixed assets, other real estate owned, intangible assets, and any other assets, amounted to about 27% of total assets. And then investment securities also generate income and provide banks with liquidity. And these include interest-bearing deposits purchased from other financial institutions, federal funds sold to other banks, repurchase agreements, U.S. Treasury and agency securities, municipal securities issued by states and political subdivisions, and mortgage-backed securities and other debt and equity securities. And in 2021, the investment portfolio was about 26% of total assets. So, commercial bank assets are mostly loans at 46%, with 27% of them being fixed assets and 26% being investments and securities. And that's just approximate numbers. Commercial banks do face unique risks because of their asset structure. One of their biggest risks is credit risk, and this is the risk that promised cash flows from loans and securities held by the financial institution may not be paid in full, like a consumer taking out a car loan and not making their payment on time or not making any of their payments. Another risk is liquidity risk. This is the risk that a sudden and unexpected increase in a liability withdrawals on your deposit accounts might require them to liquidate some of their assets in a very short period of time and at losses or low prices. Interest rate risk is the risk incurred by a financial institution when maturities of assets and liabilities are mismatched and interest rates are volatile. Then, credit, liquidity, and interest rate risk all contribute to a commercial bank's level of insolvency risk. And this is the risk that a financial institution might not have enough capital to offset a sudden decline in the value of its assets relative to its liabilities. Loans and investments, securities, continue to be the primary assets of the banking industry. Loans secured by real estate have consistently been the largest asset class for community banks from 1992 to 2019. But real estate loans have been shrinking steadily from 2007 to 2014. In 2016, the volume of 1 to 4 family mortgages originated by non-banks surpassed the volume originated by banks. So, banks or financial institutions are heavily regulated. It's difficult for them to make certain transactions. So, a lot of financial companies that are not actual banks have entered financial markets, and they are finding ways to originate mortgages and other types of financial products, and they're not regulated. So non-banks accounted for 52.5% of the volume of family mortgages originated in 2017, and that's up significantly from the financial crisis era low of 23% in 2007. So the proportion of commercial and industrial loans have been declining also since 2000. Commercial banks' liabilities are the sources of funds to use for loans. They have two major sources of funds. They have deposits, which is their transaction accounts, savings accounts, and time accounts, and then non-deposit liabilities, and that is the federal funds sold, repurchase agreements, and notes and bonds issued, showing on the balance sheet. The liability structure of banks' balance sheets tends to reflect shorter maturity structure than that of their asset portfolio. So, liabilities of banks usually have a shorter maturity than assets. Assets usually have a longer maturity overall, on average, in a portfolio. Relatively more liquid instruments, such as deposits and interbank borrowings, are used to fund relatively less liquid assets, such as loans. Interest rate risk or maturity mismatch risk and liquidity risk are the key exposure concerns for bank managers. Commercial bank equity capital consists mainly of common and preferred stock, surplus or additional paid-in capital, and retained earnings. Commercial bank equity capital was 9%, almost 10% of total liabilities and equity in 2021. So 10% of your liabilities and owner's equity was equity capital on average in commercial banks in 2021. The largest banks are subject to annual stress tests, and these are designed to ensure that the banks are properly capitalized. We've talked about off-balance sheet activities. The reason banks engage in these activities is because they have fees associated with them, and they can contribute to that non-interest income. These different types of off-balance sheet activities include the issuance of various types of guarantees, like letters of credit, making a future commitment to lend to a customer, engaging in derivative transactions, and this is a big one, forwards, futures, options, and swaps. Off-balance sheet assets, when an event occurs, so an off-balance sheet asset is a contract, and it says if this happens, then this reaction will occur. And when an event occurs, this item, so when the contingency happens, the item moves onto the asset side of the balance sheet, or income is realized on the income statement. So it either turns into an asset or it becomes income that is realized on the income statement. For off-balance sheet liabilities, when an event occurs, this item moves onto the liability side of the balance sheet, or an expense is realized on the income statement. Banks have both earnings and regulatory tax avoidance incentives to undertake these off-balance sheet activities. The use of derivative contracts accelerated during 1992 through 2010 period, and it accounted for much of the growth in off-balance sheet activity. The notional value of off-balance sheet activities at commercial banks was $10 trillion in 1992, compared with $4 trillion of on-balance sheet activities. By 2010, the notional value of off-balance sheet bank activities was $254 trillion, before falling to $180 trillion in 2019. at the heart of the financial crisis were losses from off-balance sheet mortgage-backed securities, which were created and held by those financial institutions. Losses from the falling value of off-balance sheet securities reached over $1 trillion worldwide through 2009. TARP funds gave U.S. Treasury funds to buy toxic mortgages and other securities from financial institutions. It's important to be aware of the size, structure, and composition of the financial institutions industry. The number of commercial banks in the U.S. has been declining, though much of this is due to mergers and acquisitions. In 2021, we had 4,231 banks. In 1984, we had 14,000, almost 500 banks, 14,500. It was not until the 1980s and 90s that regulators allowed banks to merge with other banks across state lines. And that's why we had so many banks back then, is because you had to have a separate bank in every state. But in the 80s and 90s, we started having a couple of laws passed where it significantly changed that and allowed interstate mergers. So, the Regal-Neal Act that I was just getting ready to mention. In 1994, Congress passed the Regal-Neal Act, which eased branching by banks across state lines. It has now only been since 1987 that banks have possessed powers to underwrite corporate securities. So full authority to enter the investment banking and insurance business was received only with the passage of the Financial Services Modernization Act of 1999. So some of these changes were fairly recent. Shadow banking is an important term that you should understand, and this is non-financial firms that perform banking services. They're called shadow banks. Shadow banking system intermediaries. The shadow banking system intermediates the flow of funds between net savers and net borrowers. Credit intermediation is performed through a series of steps involving many non-bank financial service firms. They face significantly reduced regulation than traditional banks, and they can often perform credit intermediation process more cost efficiently than traditional banks as well. So they're strong competitors, and they're actually growing. Their presence is growing, and their market share is growing, but they're not regulated. They're barely regulated. So in 2010, the Wall Street Reform and Consumer Protection Act called for regulators to be given broad authority to monitor and regulate these non-bank financial firms that pose risks to the financial system. It's also important to note bank size and concentration. So community banks are small banks. They have less than $10 billion in asset size. This says less than $1 billion. That's incorrect. It should be $10 billion or less as a community bank. And they tend to specialize in retail banking. Retail banking is consumer-oriented banking, such as providing residential and consumer loans and accepting those smaller deposits. Decreasing both in number and importance, community banks are, as asset share has dropped from 36% in 1984 to 4.9% in 2021. Now, I disagree with the text here where they say importance. Community banks have decreased in number. There are fewer of them, but they're very important, and they're actually vital to the economy. And there's a lot of research out there that shows how important the community bank presence is, especially for the rural areas. And if you take my next course, which is Finance 437 Bank Management, we talk a lot about the difference between large international money center banks that take deposits out of small communities and use those deposits to fund loans in big cities, whereas community banks, they take their deposits from rural areas and they fund loans back in those rural areas. So community banks are responsible for a lot of the growth and development in rural areas, and it's been very important growth and very impactful, especially for regions in Kentucky. So relative asset share of the largest banks increased from 63% in 1984 to 95% in 2021. So banks over $10 billion increased, and now they hold a significant amount of the assets. And I guess what the textbook has done here is taken community banks to say that they're less than 1 billion instead of 10 billion, because I think that's the only way they could get this 95% number. But don't worry about these. The point of this slide is just to talk with you about the fact that community banks are smaller and they're different than regional and super regional banks. Regional and super regional banks engage in a complete array of wholesale banking or commercial oriented activities. They have access to the markets for purchased funds to finance lending and investment activities. Money center banks engage heavily in wholesale activity in money markets with retail banks and large firms as their clients. So, asset concentration of U.S. banks in 1984 versus 2021. In 1984, there were a lot of banks under, the number of banks in 1984 was 14,483, like we discussed. The number of banks in 2021 is only 4,800. The size of the banks in 1984, the majority of them were under 100 million. So the majority of the banks were small banks. And as far as number of banks are concerned, there were only a few banks that were over $10 billion, and the majority of the banks were small banks. The total asset size of the banks in 1984, as far as how much of the share of deposits they held, $10 billion banks and up held 34.5% of total assets. $1 billion to $10 billion banks held 28%. And you'll see the amount of deposits or assets that these banks held was fairly evenly distributed. But when you move over into 2021, this is no longer fairly evenly distributed. Banks, the largest banks, $10 billion or more, hold almost all of the assets. The smaller banks, as far as a percentage share of money in the financial markets, the smaller banks hold a much lower percentage now. So that's really changed. And why did that change? It changed because of regulation. The laws that determine how the banks can operate are what determine where the money ends up. So the laws in 1984 differed significantly than the laws in 2021, and that is what caused this shift in the assets within our financial markets and the type of banks that they're held in. There are also things in the economy that changed, like the number of loans. There was a lot more commercial activity in the later years and a lot more volume of commercial transactions. So those things also have an impact on these numbers. Still in 2021, as far as number of banks, there's a significant number of banks in the $100 million to $1 billion range, as if you're just counting the number of banks, not the amount of assets that they hold compared to the overall market. That is clear. Like the deposits and assets are mostly held by the largest banks if you're looking at the percentage of market share. But the number of banks is still, there are still the fewest number of banks that are $10 billion or more. But those banks hold the majority of the assets. So that's important to understand. There's this saying called "too big to fail," and the fewest number of banks by far hold the largest number of assets, and you have to be aware of that to understand the risks in the banking system. I think students always enjoy looking at the top 10 U.S. banks, and this is as of 2021. It probably hasn't changed too drastically. J.P. Morgan Chase is the largest bank in the U.S., followed by Bank of America, Wells Fargo, Citigroup, U.S. Bank, Truist, PNC, Capital One, TD Bank, and the Bank of New York Mellon. Size has traditionally affected the types of activities and financial performance of commercial banks. Small banks typically focus on the retail side, as we mentioned before. They generally hold much fewer off-balance sheet assets and liabilities than large banks. They rarely hold derivatives. They are more sheltered from competition because they have highly localized markets, and they lend to smaller, less sophisticated customers than the larger banks do. Large banks, they usually engage in both retail and wholesale banking, but they focus on the wholesale side of the business. They operate with lower amounts of equity capital than small banks do. They tend to use more purchased funds and have fewer core deposits. They lend to larger corporations, which means their interest rate spreads and their net interest margins have usually been narrower than those of the smaller regional banks. They pay higher salaries and invest more in buildings and premises. They have diversity in their operations and services more so than small banks do, and they generate more non-interest income than small banks do, and that's mostly because they have more diversity in the services and products that they offer to charge fees on. It's important to understand a little bit about regulators, and if you are in the Evans Banking Program and you're taking the next banking class, you'll learn a lot more about bank regulation in Finance 437. But U.S. banks might be subject to the supervision and regulation of as many as 4 separate regulators. You have the FDIC, the Federal Deposit Insurance Corporation, and the FDIC acts as receiver and liquidator when insured bank is closed, and they manage the depositor's insurance fund, or the DIF, which is what ensures that you don't lose any money even if the bank fails. You don't lose anything within the FDIC insured amount on your account. So another regulator is the Office of the Comptroller of the Currency, or the OCC, and this is the oldest U.S. bank regulatory agency that was established in 1863. The primary function of the OCC is to charter national banks. So a bank can either be a national bank, a nationally chartered bank, or a state chartered bank, and all nationally chartered banks are chartered through the Office of the Comptroller of the Currency. Then you have the Federal Reserve System. So the Fed serves as the country's central bank, but it also has regulatory power over some banks and their holding company parent companies. You can choose whether you want to be chartered with the Fed or not, and banks make this decision based on several different factors. There are some benefits that come along with that. You also have state bank regulators, and they perform functions similar to those that the OCC performs, but only for the state-chartered commercial banks. Now, we talked about the largest banks in the U.S. This is the largest banks in the world, the top 20. We only have 1, 2, 3, 4 U.S. banks in the top 20 banks in the world, if that gives you some perspective. China has the 4 top largest banks in the world. Then comes J.P. Morgan Chase in at number 5. Then we have Bank of America at number 7. But we have a couple of banks in the UK, Japan, China, for the most part, and then Spain and France. And that's all I have for you for the chapters 1, 2, 4, and 11 for the review for the midterm exam. Thank you.